Yeah, good afternoon. Stephane Malrait. I'm the head of e-commerce at Société Générale for FX and fixed income product, credit rate and emerging markets.
Alun Cutler, Director of Product Management, Charles River in London, covering the EMEA part of the business.
Adrian, Berwick, Head of Fixed Income Trading and Pioneer Investments in Dublin and London.
Simon Maisey, I'm Head of Finance and Business Management for Tradeweb.
Gero, Breuer, Head of Trading Order Desk at BayernInvest in Munich, Germany.
Okay, so maybe we're going to start with a question linked to the evolution of regulation, because obviously the evolution of e-trading is based on the new regulation. So there are discussions that are ongoing to calibrate the threshold and waivers that will differentiate liquid instruments from illiquid instruments on different types of electronic platform. So maybe my first question would be to Simon. What is your view on how can a fixed income instrument, whether it's cash or derivatives, be considered as liquid?
Thank you. So I think, as we kind of heard earlier, the liquidity definition is critical. It drives all of the kind of pre- and post-trade transparency requirements. I think the way ESMA are looking at it, some of the things they've got out there in terms of the number of days a product trades on, the number of trades a day, the volume traded, all kind of make a lot of sense. Another interesting one to look at, I think, would be the kind of quote-to-trade ratio. So that how often the market moves driven by other markets moving rather than activity in a particular instrument. But actually, I kind of think all of these things that in the kind of final outcome, none of them will matter. Because actually, if you look at what the regulator needs to achieve, there's a kind of heavy political objective to capture a large part of the market. And even under ESMA's own data, they looked at kind of all of the bond data, 55% of the bonds didn't trade at all in a year. And although it captured a majority of the volume, 60% of the volume, only 2% of the bonds traded once a day in that year. And so I kind of think that there's no way that ESMA will come out with anything that anyone here would think is a sensible definition of something that's liquid that's going to be politically acceptable. So I'm kind of very sympathetic to the regulator. They're going to have to come up with something that is beyond what people will probably reasonably think is liquid. And what I think is critical, what we think is critical, that they allow a sufficient flexibility in the trading protocols that even when if the kind of transparency requirements are imposed on products that really aren't suitable for them, there's enough flexibility in the trading protocol to avoid severe market disruption. And I think that's the key to us, is that kind of flexibility in how business gets done.
Okay, so also when it comes to evolution of e-trading, so our panel, it often means big impact at front office level, especially considering the number of new order and execution systems that are out there and the limited room on the trading desk. So maybe a question for Alun. How do you prepare the integration of new systems, and what kind of issue do you have to face at front office level?
I think one of the big ones at front office level, as you said, is just the number of platforms. We talked about growth and fragmentation and then consolidation back in. I think we're moving in that phase now about the fragmentation. It means more visibility to liquidity, things like this. So what we as a vendor have to do effectively is find a way to consolidate that in a single platform. All the functions of an OMS and EMS in one place, so that you can provide the liquidity visibility, you can see the axis runs, inventory data against any order flow you're seeing, also potentially with the order flow you've seen in previous time to work out where you've executed that liquidity. So fundamentally, it's a case of just providing a single portal effectively to all these various venues. And in some respects, the openness to be able to do that as platforms come online, traders want to use them, but then as they drop away and new ones come in, it's that ability to flick them in and out, basically.
And Adrian, maybe you want to...
For us, it was a different type of situation. I think connectivity in general is fine across the marketplace. Our problem was choosing an OMS that would suit our structure properly. In my lifetime at Pioneer, we've had 4 OMSs. At some times, we've had 3 different OMSs and different hubs. It was just impossible, even for management, to get an idea of what was going on. So we took the decision a couple of years ago to get an OMS that would service all the products that we trade on one platform, and we went for that. But that was the big push. It took 2 years to get to that stage. And now we're there, it makes a big difference, in terms of efficiency, speed, visibility. big change for us.
And are there lessons learned based on the previous integration for the next integration you're going to have to do?
I wouldn't do it again, to be honest with you. But to be fair, a lot of the providers on OMSs are very good on equities, and I think they're state of the art, and there's no issue there. I think the big challenge that the buy side have is on fixed income, particularly on OTC trading, and the more you go down, let's say cross currency swaps, those type of asset classes, that's where it gets trickier. The types of issues we had really weren't from connectivity, because from day one connectivity worked. The type of issues we had was broker mapping, broker restrictions, commissions being incorrectly set up, and well, the more serious thing would be the feeding from Reuters, changing a life product into a Eurex product. That type of thing is pretty serious, but they're the type of issues we had, but thankfully we overcame them.
Okay. So in the previous panels, we've heard a lot about reflections aiming at standardizing communication protocols or defining add-ons to the fixed protocol in order to ease the access to multiple liquidity pools and shared inventories. So maybe now a question for Stephane. Could you tell us how this can help and what is being planned exactly in this field? And also, we understood from what we heard before that these initiatives seem to be led by the buy side. So since you're on the sell side, how do you support this initiative?
Yes,
and what do you do exactly?
I was amazed this afternoon to see a panel where there was 3 different buy-side initiatives together on a panel. Right, this could not have happened 2 years ago, right? It's the first year that we see that, and I was like, this is really new to this industry, and for us, it's really a challenge in a way, because we value very much the relationship we have with our buy side, and we have to be transparent to the different technologies that are in trading solutions that our clients are going to choose. So with those 35 initiatives, I think it's very important for us that we start to have standardization on the market. And that's why we pushed working together as an industry, buy side and sell side, to create this project called Neptune, where we are going to push adoption of fixed technology to standardize the process at a pre-trade level. This is for us an important first step to be able to drive that standardization and to work none in a sell side only way or none in a buy side only way was, for me, the way of the past, but to work as industry member together. And it's close to, I think, 30 large companies who are working together to this definition of the fixed protocol. So it's quite important for us. It's too early to say which one are going to win, which one are going to lose. Contrary to the previous panel, I think in 3 years' time, there will still be 35. If I was going to create a platform today, I will make sure there is enough cash to wait until 2017 when MiFID is alive. Because this is where I'm going to get my clients really set up to my trading system. So in 3 years' time, there will still be 35 platforms. So we need to have a very cheap way to connect to them.
But in this kind of initiative, for instance, Neptune, how do you differentiate your role compared to the role of the buy side in the design of this model?
So it's the definition of the instrument and the protocol that we want to use to send information between each other. So we are all experts in our domain. So I think it's from a sell side point of view and buy side point of view, it's the expertise, business expertise that we have to give. So that's the first point. The second point is the technology expertise, is the technology connectivity that we use from a sell side is not the same as the buy side. So we are less a client of Charles River, for example, but we have our own software vendors who are specialized more on the sell side. So we have our own connectivity issues that we have to work. And I think the buy side will have to work with their software provider as well to drive that implementation. So we have a second track in Neptune with more technology implementation, how do we do it as well. So for the moment, the relationship is working pretty well between the different actors.
Okay. Maybe Gero, you can give us your view on this kind of, as a buy side, on this kind of initiative?
Yeah, well, I mean, I think everyone heard now 10 times that it is important, but why? I will have a look again at the equity world in order to show how, in some ways, equities are executed electronically. And you can use an algorithmic trader, and from there, various trading places are connected, and there the liquidity is collected. Because I don't think that in the new world, when we have 3, 4, 5, 10, 30, 20, 50, 100 various platforms where bond prices will be quoted, we will have people sitting there in order to look at each platform. So this will be done by some kind of master system, smart order router, or asset service or algorithmic provider, and this is where the further evolution of protocols is important. And it's a very important initiative, that's what I think.
I think one thing on that I think that's too important, that the kind of connectivity piece is important, not to be thought of as one of the kind of 35 initiatives that Stephane mentioned that kind of may succeed or not, but the connectivity bit should be really open, allow kind of connectivity across any different part of the market infrastructure, such that it's not around like trying to make a bet on one thing, but it should be around like saying, when there's lots of these things, it reduces the cost and the risk of connecting to the wrong one, or kind of how you tie all of these things together. So I think the kind of thinking of it slightly differently and saying like it's really open, that's the key on the kind of standardizing the connectivity, rather than like whether it's an execution venue or something else.
Yeah, I will agree with that. When we talk about 35 initiatives, it's probably in cash credit world, but if I look at the FIC world, the fixed income and currency world, I listed probably 200 different venues that we can connect to, and at Société Générale we connect to already 140 of them. So it's a huge bill of connectivity that we have to manage every year, and as you know, cost now is something we looked very closely at. So we are very passionate to drive that cost down.
The reality is for the buy side that if I was to go in and ask for 40 new platform providers to get connected up to, I'd be laughed off the stage. So it's not going to happen. But some of these products or some of these offerings are very valid, they're interesting, they're innovative, and they're worthwhile. It's our view that the sell side shouldn't be competing on fixed protocol, because it's there anyway. It's just you have to obviously do a bit of work to get this initiative off the ground. But the positive part of this initiative is that for the first time you've seen buy side and sell side together in a reasonable number, discussing an initiative. And even if it doesn't take off the ground, it's still a positive sign.
Okay. But when it comes to standardizing technology, obviously it means an easier integration and cost efficiency, which is something that everybody's looking for. But considering the size and the diversity of the fixed income market, maybe we could wonder if we think that a full standardization of the market is possible. And if it's possible, is it going to be done, in the coming years or much later? Is it going to take a long time? And if it's not possible, except we know that at fixed level, at the communication protocol, it's possible to standardize, but are there other layers in the value chain when you think there can be a full standardization? So I don't know who. Yeah,
I can take a peek at this one. I don't think it's an issue, because something even if we talk about 30 platform, we talk about just a few OMS to connect to. We talk just a few number of bank will start to and a large, much larger buy-side community, but still reasonable compared to the number of bond and instrument we have to quote. And so the diversification that you talk about it's true that, and we are part of it at Société Générale, we don't have a strategy that we are going to be good in all product, all region. we have this strategy of a multi-niche approach, being good in certain products, but being very good at it, and so it's different to other banks in that way. So I much prefer connect to 40 platforms and saying, you know, I'm going to be very good at those instruments or this group of instruments on those 35 platforms than the opposite. You know, to give you an idea, we categorize the fixed income market is probably around 20 different products. We feel we are, you know, very competitive on probably 10 of that, and we probably are a leader on 5 of those. So that's the way we'll market ourselves, to say 5 of those 20 products, we are really the leader on the market, so you should ask us when you come to us. And wherever platform you choose, we want to be on the other side because we are a leader on the market.
I think, well, the standardization, I think we all say FIX is one of the major standardized message platforms. FIX 4.4 has been around for a while now, which is fixed income enabled. I mean, we're starting to take direct market data messages for inventory stuff over FIX 4.4 with some of the banks already. So I think any delay just seems illogical at the moment because the platforms are there, and in some respects, the sell side have these platforms because from the equity side already on the fixed platform. So it's just a case of adapting it into the fixed income space, as we said. It's just driving that change.
I think there are some areas where you want standardization, some where you don't. So as I mentioned earlier, I think on protocols you don't want standardization, you want to allow that flexibility. And I think these things do take time. As Stephane said, like Tradeweb, we implemented FIX for connectivity in 2011. The 3 years, we still, you know, about half of our liquidity providing banks have connected via FIX. So it takes a long time. And I think the point there is, as I said, to be the kind of standardization of that connectivity allows a kind of leveling of the playing field of people coming in and out. If you look at one of the big differences between fixed income and foreign exchange is the way banks connect or users connect to those platforms. In foreign exchange, the platform's connected to the users. And that allowed, you know, there's now a multitude of platforms connected very quickly. In fixed income, it was up to the users to connect to the platform. There's kind of cost pressures there, it's kind of much harder to get started. So that kind of kept the number of platforms much smaller.
Okay, so let's go back to another recurring topic, RFQ. Obviously, MiFID II is going to bring transparency rules to the specific types of, to the different types of platforms and to the liquidity level of instruments. So the historical RFQ model is likely to evolve, not necessarily to disappear, but to evolve. So my next question will be to Stephane, as a major promoter, obviously, of RFQ. What is your view on this potential or this expected evolution, and what are the benefits and drawbacks for you as a bank on this evolution? And do you think that the evolution of RFQ towards something different is going to help develop liquidity on the market?
Yeah, so we looked at this very thoroughly from a strategic point of view over the last 2 years, because since the change of regulation was announced now for 4 years ago, there was this fear that the market were going to move completely to an equity-style market. And now, talking even to regulators, you know, today or even last week in France, we got this reassurance that in fact, you know, it took time to discuss why it was good or bad for fixed income market, but the story is going to be that in Europe, you know, we are going to have this different model where you can trade on an MTF, on an OTF, on an SI, and there is no mandate of trading that you have in the US. So you can still have a voice, and people forget about that, you can still have a strong voice business market going forward. You can still have a strong RFQ market going forward. But you will have, on top of that, probably more order-driven markets who are going to develop, because there is the need, and it will fit for purpose. So I was very pleased with some of the existing trading platform in Europe going to start to propose an evolution where where they will have RFQ and order book with their offerings, the same way we have in the CEF in the US. Because at least we give choice to the clients. So you don't choose a platform because it's a pure order book platform. You choose a platform for the holistic environment that they provide to you as a technology provider. And within this environment, you can trade RFQ, but you can also trade order book. I think it's a style also which is going to fit some users or some new entrant into the fixed income market and less for others. It's an example I use a lot, but what we see in FX is in FX you have a lot of order book platform, and you have RFQ platform, and you have streaming executable platform, and you can still trade on voice. And over the past 10 years, the order book platform didn't pick up for the corporate segment at all. Right, the corporate segment love to trade on RFQ, and they continue to trade that way because they get guaranteed liquidity for size. The hedge fund community prefer to go order book because it's anonymous. They can hide behind the anonymity of the order book, and they can go in and out very quickly for smaller size and use algo. So it's a very different trading style for very different client base.
And maybe an additional question based on what you just said. It's true that there's no trading mandate, but there are rules where you can trade OTC up to a certain level, after which you fall into the SI or OTF category. So how are you going to handle this border between the two, or these limits that if you want to preserve your OTC model?
No, but it will still be OTC, but one will be voice, the other one will be RFQ models. I think we will evolve. I think what we are trying to do now is still continue to speak a lot with regulators to try to define that was the opening statement with Simon is how do you define liquidity? And this is the biggest problem now. What is liquid, what is not liquid? And we can have very different views when we speak to regulators on that. And the block size is going to be very important. So before we adapt to our model, and we still have 2 years to adapt, is really making sure that everyone understands the impact about this very important definition of what is liquid versus what is non-liquid.
Mm-hmm. So maybe looking at the buy side now, the buy side has been pushing for more transparency, and obviously they are getting prepared to the new models that are going to prevail with after MiFID II. So maybe first question to Gero and maybe after to Adrian. What is your view on how this is going to impact your trading processes and your technology? Because things are going to change and you're going to be impacted.
Yeah, well, first, I don't think that the buy side is pushing for more transparency. That is not my view from the discussions. If you look at equity conferences, you will have at least some people thinking that the transparency is good because of the dark pool discussions. But in the fixed income world, it's my view that most market participants are on the buy side too very skeptical about the transparency rules. They think it's more going to, it has a negative impact, and I think most buy-side companies fear this. What are we doing from a technology perspective? This easy, nothing. The reason is because we as on the buy side, we will not have to do. I mean, we will trade then if we see something has to be transparent and there has to be pre-trade and post-trade transparency. We will trade it on a platform. Mm-hmm. Because then I think the trades will go to a platform, because that's the only reasonable way, or probably what I expect the reasonable way where how to provide that pre-trade transparency. And if the market will be negatively impacted by the rules, I fear that we will not buy the bonds anymore. That's it's not a trading issue. It's an issue of the investment process, because the bonds that will be negatively impacted, there will not be any investments in them.
Mm-hmm. Adrian, maybe you want to.
Yeah, I mean, it's an issue. It's particularly an issue for us on the OTC side. I mean, certainly we wouldn't want. We did a two-year and 500 million. We wouldn't want that publicised straight after we traded. Like the buy side, the sell side wouldn't like that either. So it's something going forward we really need to be wary of. I mean, a certain amount of transparency is good, certainly, but it has to be on a level playing field as well. I'm not so sure about the whole trace system. A lot of people discuss about trace. It's not bad as a reference point, but the problem with the trace pricing is that you're expected to get that price, and if you can't get that price, then you have a best execution issue to discuss. Also, if I trade a bond that is a traceable bond, but I trade with a European counterparty, that won't go on the trace system. So it just needs to be a level playing field if we go down that route.
I'm just thinking about something based on what you just said, Gero. You said that transparency can be dangerous, obviously depending on the sizes of the orders. Where would you put the threshold where transparency becomes dangerous at pre-trade level in terms of order size?
Well, the current rules that I'm aware of, 480 trades per year on 120 day and 100,000 euro average turnover. This is something where probably only 5% of the bonds and 85% of the volume are affected by. This is probably not dangerous. And but I just wanted to say it's not true that the buy side in general is in favor of more transparency. My feeling is that unlikely in the equity world, where it's at least, well, it's discussed, where some people think it's okay, some people are skeptical about it. On the fixed income side, there's a very widespread skepticism, much more than on the equity side, on those rules. And I think it's a rather theoretic question. I mean, what is a liquid bond? I mean, there are many criteria that are relevant.
And maybe, Adrian, in terms of specifically order size, when do you think an order should not be advertised or publicized in a transparent model?
I mean, you can see it on the MTFs currently. I mean, 10 million, 20 million is fine in a govy bond. I don't think, and even the sell side, I don't think would have too much problem that being publicised. The problem is when you go out in 200 million, 300 million sizes. It's the bigger size, and it has to be relevant to the markets as well. I mean, Italy is very liquid at the moment. Spain is liquid at the moment. But when we had the crisis a couple of years ago, it was very hard to shift peripheral govy bonds. So I think it's a combination of what's acceptable at the time, but you need to take into account what's going on as well. I mean, it's not an exact science, to be perfectly honest with you.
Okay. Well, maybe looking at the solution providers now, from maybe a question for Simon from a platform operator standpoint regarding transparency rules on RFQ. What do you think are the technology requirements for moving from an electronic environment in line with to an electronic environment in line with MiFID II? And do you think that what happened in the US can be compared to what's going to happen? Are there lessons learned from what happened in the US?
So I think on the US there probably aren't, because the US, as Stephane said earlier, they kind of forced a very prescriptive definition of the protocol. They didn't have the kind of pre-trade transparency requirements. And I think that's where on RFQ there is kind of, with the current rules proposed in Europe, there is an issue on pre-trade transparency and how RFQ works, because they've kind of defined it in a way with really thinking kind of the function of an RFQ and the value that adds. So the kind of RFQ adds kind of three purposes: the efficient risk transfer, blocks of risk, the kind of minimizing the adverse impacts of own less liquid products, and kind of being able to execute something that's customizable. And if you kind of have pre-trade transparency before that, you're kind of defeating some of the point of it. So I think we're reasonably confident that the regulators now recognize that what's being proposed, that responses to RFQs get made public as soon as they come in, somewhat defeats the point of RFQ, because you end up with an incentive to quote very, very late, which is not a very good client experience. And that's one of the things we've been trying to provide, is like a platform that gives a good client experience. So they kind of seem to be open to kind of, okay, let's have another look at that. Let's try and find a way for that to work. And whether that's you kind of have some method of like enhancing the composite that's already there, or you're kind of batching orders up, or kind of providing like a two-step in terms of transparency. I think that's what we just need to work on, coming up with something that meets the regulatory objectives and kind of still means that the purpose and the value in RFQ still exists.
Mm-hmm. Alun, maybe you want to add something on this?
I think, as I said, transparency is like a double-edged sword. I think that's what we're basically pointing out in the illiquid space versus the liquid space. The advantage of some form of transparency in the liquid space gives us that TCA analysis, the ability to do transaction cost analysis and do some of that. But as I said, I agree with the panel in terms of it's not particularly applicable in the illiquid markets. There's nothing to base it on, and it just probably gives you wildly inaccurate views.
Okay, so just I think there was a discussion or something that was mentioned in the previous panel regarding commissions being paid for execution versus markup. And this is also a major evolution that we are expecting or not, depending on what the market is pushing for. So maybe it would be interesting to have your views on, and maybe the sell side first and then the buy side, and maybe also the platform, how you can adapt to this new model. How do you envisage a change of billing from markup, the existing markup, to a commission-based billing model?
So what is very interesting is we know that the bank industry is under enormous pressure to change since the last 4 or 5 years. And so far, there was no indication of how, until this year really, how those banks were going to react. And this is the first year in 2014 when we see suddenly like 4 or 5 banks coming up with the announcement about agency execution being part of the investment bank model. So we learned about UBS at Société Générale. We had New Age now is part of our group, very integrated and very big as well as an execution house for agencies. And other large banks have announced as well their plan to have a dual approach with a principal model and an agency model. And I think that's a right way to finally come up with a solution to say, yes, potentially we'll continue to have a market-making activity on a principal model where we get remunerated on the bid-ask front, but at least we offer an alternative where we have an agency execution desk with who have access to the market, who have access to all those executing venue, and we can act on a commission-based approach. So we have Chinese wall in our case between the two. We work together as well to see what is best for the clients to offer both options to the clients, and we have clients who have supported on both sides, who are act with us on the principal side, but who also use us on the agency side, and we have clients who are just on one side, on the other side. So the two, I think, for the moment, will start to coexist, and it's quite new for fixed income market. So we are. It's probably a little bit early to be able to say how far it's going to evolve, how fast it's going to evolve, but that's why for me, we are going to have a few years where we are going to have the two, and then we are going to see if there is a move toward one side or more the others.
Okay. Adrian and Gero, maybe if you want to, from the buy side
perspective. It's just an extension of what's going on the equity side, really. So I don't think it's a big deal. We just have to document it and have to come to some. There has to be some sort of standard rate that's agreed to, and
Yeah, it's a very good point. We don't see any resistance on it from the buy side, because a lot of the buy side, as you say, is very used to that model on the equities. Yeah. So in fact, they are quite happy to have that coming on the fixed income side to say, oh, this is an alternative, and I'm pleased that you have this alternative. But it's not because you have that alternative that's going to close the relationship I have with you on the principal side.
And is it complicated to implement from a technology standpoint on the platform?
I think it's not from our point. When actually I left the sell side to join Tradeweb, one of the things I was pleased about was not having to worry about the kind of problem of introducing an agency fee anymore. And so I think from our point of view, it's fine. We run both models where there's like a principal or relationship-based execution, or there's the kind of more anonymous execution fee type one. I think the one that, so like for us, it's kind of, we're largely indifferent. I don't think it's really our problem. The one thing I would say is that we like providing a platform where there's still a kind of relationship-based approach between both sets of our clients. I think that's kind of a very interesting space. There's more value to be added in doing that. So we do like that model. I think it's a kind of interesting place to be.
Okay.
Yeah, from our side of it, we've said we're an equity platform as well, so we've already seen this through the equity space in terms of the splitting. I think the problems come back to not so much on the trading and execution side of it, it's more downstream. Because suddenly you get into potentially days where you're paying both a research and X commission and then also just an execution commission within the same trading day, which can complicate the workflow. You end up with manual calls and things like that, so it's kind of breaking some of the STP, otherwise you get fails. So I think that's one of the things that's got to be, as it moves into fixed income, is take that into account. It's like how you push this through the automated STP workflow without breaking it, because we see different firms adopting different approaches to it, which is actually confusing it somewhat.
Okay.
Definitely, you don't want to triple charge the clients, and it will not look good in front of the regulators. And I think our approach for that is to separate the two. The principal and the agency side is probably the right approach, because then you say when you act as a principal, you just act as a principal, and that's a business want to act. When you act as an agent, you just act as an agent.
Okay. Well, thank you. Being conscious of time, maybe we can open the floor to questions. Are there any questions? One last question for the last panel of the day. Everybody is very tired. Okay, so I guess we can thank our panelists for their presentation.